As the sun rose on January 20, 2025, the United States witnessed the re-inauguration of President Donald Trump. His return to the Oval Office signaled not just a continuation, but an intensification of the protectionist policies that had characterized his first term. For investors, policymakers, and everyday citizens, the air was thick with anticipation and uncertainty. The global economic landscape had been shifting since the early 2020s. The US-China trade war, which began in 2018, had seen various ebbs and flows, with tariffs being imposed and lifted in a tit-for-tat manner. However, the re-election of President Trump brought a renewed vigor to the America First agenda. On February 1, 2025, in a move that sent shockwaves through global markets, President Trump announced a 10% increase in tariffs on Chinese imports. This decision was swiftly met with retaliation from Beijing, which imposed a 15% tariff on U.S. coal and liquefied natural gas and a 10% tariff on crude oil, agricultural machinery, and large displacement vehicles. The initial reactions were mixed. Some American companies, particularly those with deep ties to Chinese manufacturing, expressed concern over the escalating costs and potential supply chain disruptions. Yet, a survey conducted around this time revealed that approximately 70% of U.S. companies plan to maintain or even expand their operations in China, despite the looming geopolitical tensions. This resilience was attributed to China's vast market potential, advanced infrastructure, and skilled labor force. However, beneath this facade of business as usual, there were undercurrents of apprehension. The same survey highlighted that 83% of respondents viewed China as the primary geopolitical risk, citing concerns over national security policies, market exclusion pressures from China's innovation agenda, and instability in the Taiwan Strait. Investors, always keen to anticipate and react to policy shifts, began re-evaluating their portfolios. The technology sector, which had been the darling of Wall Street for over a decade, found itself in the crosshairs. Semiconductor companies, in particular, faced the brunt of the trade tensions. The U.S. government's decision to tighten export controls on advanced AI chips and chip-making tools aimed to curb China's technological advancements. This move disrupted the semiconductor supply chain, affecting industry giants like NVIDIA, Micron Technology, Intel, and Qualcomm. The ramifications were immediate. Stock prices of these tech behemoths experienced volatility, with investors wary of potential revenue losses from the lucrative Chinese market. Analysts began downgrading growth projections, and whispers of a looming recession grew louder. Deutsche Bank issued a stark warning, suggesting that the aggressive tariff strategies could jeopardize the stock market, the U.S. economy, and the global order. The bank's researchers described the tariff move as the most profound shock to the global trade system since the 1970s. Amidst this backdrop, individual investors grappled with decisions that could impact their financial futures. The allure of high-growth tech stocks was now tempered with the reality of geopolitical risks. Diversification became the buzzword, with many seeking refuge in sectors deemed less susceptible to trade tensions. Yet, the interconnectedness of the global economy meant that few industries were entirely insulated. As February gave way to March, the trade war showed no signs of abating. President Trump doubled down, raising tariffs on Chinese goods by another 10%, bringing the cumulative tariff rate to 20%. China's response was swift and calculated, imposing additional tariffs on U.S. agricultural products, including a 15% tariff on chicken, wheat, corn, and cotton, and a 10% tariff on sorghum, soybeans, pork, beef, aquatic products, fruits, vegetables, and dairy products. The agricultural heartland of America felt the sting. Farmers, already grappling with unpredictable weather patterns and fluctuating commodity prices, now faced diminished export opportunities. The Chinese market, once a reliable destination for American produce, was becoming increasingly elusive. Government subsidies aimed to cushion the blow, but many in the farming community viewed them as a temporary salve for a deeper wound. In the boardrooms of multinational corporations, strategies were being redrawn. Supply chains that had been optimized for efficiency were now being reconsidered for resilience. The concept of decoupling gained traction, with companies exploring alternatives to Chinese manufacturing hubs. Countries in Southeast Asia, such as Vietnam and Thailand, emerged as potential beneficiaries of this shift. However, transitioning production lines was neither swift nor straightforward, and the specter of increased operational costs loomed large. Financial markets, ever sensitive to policy changes and economic indicators, reflected the prevailing uncertainty. Bond yields and inflation expectations declined, oil and copper prices plummeted, and investors began anticipating interest rate cuts by the Federal Reserve. The term recessionary wave entered the lexicon, capturing the sentiment of an economy teetering on the edge. Axios. Yet amidst the turbulence, there were glimmers of opportunity. Some investors viewed the market corrections as a chance to acquire quality stocks at discounted prices. The belief in the long-term potential of technology and innovation remained unshaken for many. Moreover, sectors such as renewable energy and healthcare were seen as potential havens less directly impacted by the trade skirmishes. As the first quarter of 2025 ended, the aftershocks of the renewed trade war reverberated across small-town America. In Iowa, Kansas, and North Dakota, family-run farms began to feel the pinch. These were not just patches of earth, but legacies passed down through generations. And now, those legacies stood threatened not by drought or flood, but by policy and politics. Jason Myers, a fifth-generation soybean farmer from Mason City, Iowa, watched with growing anxiety as cargo ships that once carried his harvest to Chinese ports now sat idle. "We spent decades building trade relationships," he said in an interview with a local business podcast. "And in a matter of months, tariffs destroyed all of that." Jason had recently invested in new harvesting equipment, banking on a stable export pipeline. Now he was considering renting out part of his land just to break even. Wall Street may have been thousands of miles away, but investor sentiment was increasingly shaped by stories like Jason's. Institutional investors, hedge funds, and even small-cap investors began pulling out of agribusiness stocks, fearing long-term volatility. Companies like Archer Daniels Midland, Bunge Limited, and Deere & Company saw sharp declines in their stock prices. In response, the U.S. government unveiled a $30 billion agricultural aid package deemed by critics as Band-Aid economics. While the checks offered temporary relief, they failed to restore market access. American farmers were effectively caught in a crossfire with no clear end in sight. At the same time, over on the coasts, logistics companies were undergoing a transformation of their own. Port activity slowed in places like Los Angeles and Long Beach. Export volumes to China plummeted, and container ships that once made routine round trips to Asia now found themselves rerouted to smaller, emerging markets in Africa and Latin America. The U.S. Chamber of Commerce, typically a vocal advocate for free trade, released a damning report in April 2025. It estimated that the tariff war could cost the American economy up to $125 billion annually in lost output if left unresolved. The report also forecasted nearly 400,000 jobs at risk, particularly in manufacturing, agriculture, and retail sectors. But not everyone was running for cover. In Silicon Valley, a different narrative was unfolding. Startups focused on domestic manufacturing, robotics, and AI-powered supply chain management saw a surge in venture capital funding. The logic was simple: if overseas production became risky or expensive, the solution was to innovate at home. One standout was a San Jose-based startup, Machinacore, which developed fully automated microfactories capable of producing complex electronics using minimal human labor. CEO Priya Varma believed the trade war was a necessary catalyst for American manufacturing reinvention. It forced us to ask, why are we still outsourcing so much when we have the talent, the capital, and now the technology? Her company's valuation tripled within 4 months, and interest from defense contractors and domestic electronics firms poured in. Investors began shifting their portfolios toward startups like Machinacore, betting big on the trend of reshoring, bringing production back to the U.S. Meanwhile, traditional multinational corporations were walking a tightrope. Apple, caught in the geopolitical undertow, accelerated its diversification strategy. It moved a significant portion of iPhone assembly to India and Vietnam, while lobbying the U.S. government to grant exemptions on critical components still made in China. Other tech giants followed suit. Microsoft ramped up its Indonesian server farm project. Tesla increased battery production at its Gigafactory in Nevada, while slowing down expansion plans in Shanghai. The shift wasn't immediate, but it was unmistakable. A slow decoupling of two economic powerhouses. Investors tuned into quarterly earnings calls with bated breath, deciphering CEO statements for clues about corporate strategies. Words like de-risking, geopolitical hedging, and supply chain resilience became regular features in investor briefings. By May, the S&P 500 reflected the schism. While some sectors like defense, domestic manufacturing, and energy outperformed, consumer tech and multinational conglomerates lagged behind. Index funds that once offered safety in diversification began to feel uneven, with some sectors dragging others down. Media narratives, too, evolved. Major outlets like Bloomberg and CNBC launched special segments titled Trade War Tracker and Tariff Watch, which analyzed weekly developments and predicted stock movements. Even retail investors on platforms like Robinhood and E-Trade began reallocating portfolios based on these cues. Amid this chaos, a quiet but powerful shift was occurring in investor psychology. The playbook was no longer just about fundamentals or technicals, it was about geoeconomics. A company's political exposure became as important as its earnings report. A single tweet from the president could wipe out billions in market cap or create a windfall for defense contractors. Still, many believed the U.S. had the upper hand in the long term. With energy independence, vast natural resources, world-class universities, and the dollar's status as the global reserve currency, America retained its economic crown. The belief among some institutional investors was clear: short-term pain, long-term gain. The question on everyone's mind wasn't if the trade war would end, but when and under what terms. Summer of 2025 arrived, not with warmth and optimism, but with an air of tension and anticipation. By June, it was clear that the trade war between the United States and China was not just a diplomatic spat, it was a full-blown economic reordering. And for investors, the ground beneath their feet was shifting faster than ever before. What made this chapter of the trade war different wasn't just the tariffs, it was the bifurcation of the global economy. The world, once moving toward interconnected supply chains and shared markets, was now cleaving into two major blocks, one orbiting around the United States and the other around China. American investors found themselves facing difficult choices. Should they pull out of Chinese markets completely or ride out the storm in hopes of long-term normalization? Should they double down on US-based assets or diversify into India, Vietnam, and Mexico, the rising stars in global manufacturing? For big hedge funds like Blackstone, Bridgewater, and Citadel, the answer was to pivot strategically. Blackstone increased its exposure to Indian infrastructure, betting on the country's rapid development and its strategic alignment with the West. Citadel, on the other hand, shifted its global equities strategy to focus more on Latin America, where U.S. companies were reinvesting in nearshoring operations. Ray Dalio, founder of Bridgewater Associates and long known for his bullish stance on China, released a rare cautionary memo. "We are witnessing the end of one era and the uncertain birth of another," he wrote. Investors must now balance opportunity with ideological risk. The memo made waves, sending portfolio managers across the country scrambling to reassess their China strategies. Meanwhile, retail investors, once passive spectators, were now learning a new language of macroeconomics. YouTube financial channels exploded in popularity. A creator named Macro Mike went viral with his daily series called Tariff Talks, which broke down trade policies in simple terms and analyzed which ETFs and stocks would be most affected. He gained over 2 million subscribers in just 60 days. Even on Reddit's r/investing and r/Wall Street Bets, serious discussions began to take over the usual memes. Threads like how to hedge a trade war portfolio and why Mexican rail stocks are the future received thousands of upvotes. A new era of informed investing was emerging, born out of necessity. But not all investors were winning. A story that shook the investment community came from Michigan. Susan Carmichael, a retired schoolteacher who had invested her pension into a China-focused mutual fund, lost nearly 40% of her savings in 4 months. They said diversification meant safety, she lamented in a televised town hall. But nobody told me diversification doesn't help when two countries stop doing business. Susan's story triggered a wave of regulatory hearings. The SEC faced pressure to demand clearer geopolitical risk disclosures from mutual fund and ETF managers. Senator Josh Hawley even introduced a bill, the Strategic Clarity Act, which required all publicly traded companies to disclose their foreign dependencies in financial filings. This bill gained bipartisan support and was seen as a sign that the trade war had fully entered the American political bloodstream. Wall Street could no longer afford to ignore Washington. In parallel, tech and defense sectors began to intertwine like never before. Palantir, Lockheed Martin, and Endural became Wall Street darlings. Investors were suddenly treating geopolitical data as part of their portfolio strategy. Apps and tools like GeoMarkets and Risk Matrix AI were downloaded by millions of retail and institutional investors alike, offering predictive insights on trade disputes, military escalations, and policy decisions. The dollar, meanwhile, remained king. Despite the chaos, it strengthened. With investors fleeing the yuan and euro for safer assets, the U.S. Treasury market saw record inflows. For all the market jitters, one thing was clear: global trust in the American financial system was unshaken. But there was also a deeper transformation at play. America's consumer culture was quietly evolving. A wave of patriotism swept across the country, fueled by the Buy American movement. TikTok and Instagram influencers began spotlighting US-made products, and Gen Z consumers, once obsessed with fast fashion and cheap imports, began shifting preferences towards sustainable, local, and ethically made goods. For investors, this wasn't just a cultural trend, it was a market signal. ESG funds pivoted to include supply chain ethics in their evaluation matrices. Firms that could prove they weren't reliant on adversarial nations for production saw their valuations soar. Even fashion brands like Patagonia and Levi's gained from this trend as their transparency reports became key investor documents. The great irony, of course, was that a trade war meant to assert dominance had instead sparked a massive introspective reset. America was rediscovering its industrial base, its consumer ethics, and its long-term investment priorities. The landscape was more volatile but also filled with unprecedented opportunity for those who paid attention. And while the Dow Jones remained a roller coaster, dipping below 30,000 in July before bouncing back in August, a quiet confidence was building in the background. The investors who thrived weren't the ones making the most trades, but the ones learning the most lessons. They understood that this wasn't about politics or even economics, it was about vision. Because those who could see what was coming next were already there. By September 2025, the U.S.-China trade war was no longer just a matter of tariffs or diplomatic tit-for-tat. It had evolved into a battle for technological supremacy. And the front lines weren't in Washington or Beijing, but in Silicon Valley and Shenzhen. The most explosive development came when the U.S. Department of Commerce expanded its sanctions on Chinese semiconductor companies. Overnight, dozens of Chinese tech firms lost access to cutting-edge chip designs from American firms like NVIDIA, AMD, and Qualcomm. China responded by doubling down on its state-funded Chip Independence Plan, pouring $100 billion into domestic research and development. But this technological decoupling had massive implications for global markets, and investors were watching with hawk-like precision. One of the biggest beneficiaries of this chaos? Taiwan. The island nation, home to the Taiwan Semiconductor Manufacturing Company, TSMC, suddenly found itself at the epicenter of global chip politics. As Chinese access to U.S. chips diminished, the world turned to Taiwan for supply. TSMC's stock soared, and with it, investor interest in Taiwanese ETFs and Asian tech supply chain plays. However, this also brought risks. With geopolitical tensions surrounding Taiwan escalating, investors began looking for Plan B alternatives. That's when Arizona and Texas stepped into the spotlight. Intel and TSMC both accelerated construction of their US-based fabs. Wall Street started talking about the new Silicon Prairie, a boom in semiconductor production within the continental United States. Billions in government subsidies were announced under the CHIPS Act 2.0, and investor confidence in American tech infrastructure surged. Meanwhile, Wall Street analysts coined a new acronym, MADE, standing for manufacturing, AI, defense, and energy, the four pillars expected to lead the U.S. economy into its next growth cycle amid geopolitical uncertainty. Asset managers began restructuring their portfolios around these themes. Investors like Cathie Wood's ARK Invest bet heavily on AI-based supply chain optimization tools and robotics companies. Others like Warren Buffett's Berkshire Hathaway leaned more traditional, boosting positions in American manufacturing stalwarts and railroads, especially those connected to Mexican and Canadian trade routes. Even the average Joe investor started seeing new possibilities. In Nashville, Tennessee, a 34-year-old engineer named Marcus Langston, who ran a small YouTube investing channel, became an overnight sensation after he accurately predicted the spike in domestic semiconductor stocks. You don't need to be on Wall Street to read the writing on the wall. he said in one of his videos. Just follow the chips. His subscriber count jumped from 8,000 to 300,000 in less than a month. He began offering a course called Geopolitics for Investors, which quickly became one of the most downloaded business programs on Gumroad. On the opposite end of the country, in Oregon, a clean energy startup called Solentra hit unicorn status within 10 months of its Series A. The company built modular solar power grids for manufacturing units that wanted to cut reliance on foreign energy. Solentra's pitch? Resilience is ROI. The startup's backers included Peter Thiel, and its public listing became one of the hottest IPOs of the year. Institutional money followed fast. Mutual funds, ESG portfolios, and even pension funds sought a piece of this new energy frontier. But it wasn't all smooth sailing. For every Solentra, there was a cautionary tale, like Blue Orbit Robotics, a once promising AI logistics firm that overpromised on contracts tied to federal manufacturing grants. When those grants were delayed due to political infighting in Congress, the company missed earnings, laid off staff, and its stock plummeted 76% in 2 weeks. It was a harsh reminder that policy risk had become as dangerous as market risk. The Federal Reserve, too, was navigating treacherous waters. Inflation, initially driven by rising import costs, began to cool as domestic production picked up. But a labor shortage in skilled trades, welders, chip engineers, precision machinists, created wage pressure. To balance it all, the Fed kept rates higher for longer, dashing hopes for a major rate cut that many investors had priced in. Despite the volatility, a new breed of investor was emerging, one who wasn't just looking at charts, earnings reports, or momentum trends, but at global maps, trade agreements, and raw material access. In many ways, the market was no longer just reacting to numbers, it was reacting to narratives. Who controlled the chip? Who owned the rail? Who mined the lithium? Who made the policy? Answers to those questions weren't just for think tanks anymore, they were the foundation of entire portfolios. For the first time in decades, national strategy and individual stock performance were inextricably linked. And in this new investing landscape, one truth began to dominate. The safest investment is no longer the one with the most stability. It's the one with the most sovereignty. As fall approached, investors braced for the next big trigger, the 2025 Global Economic Summit in Singapore, where the US, India, Japan, the EU, and even African Union representatives would come together to discuss a post-China global trade architecture. Everyone from billion-dollar hedge funds to TikTok day traders was watching. The chessboard had changed, the players were moving faster, and the stakes were higher than ever. As the world turned its eyes toward the 2025 Global Economic Summit in Singapore, a sense of urgency gripped the investment community. This wasn't just another diplomatic affair, it was being dubbed the New Bretton Woods by financial media, hinting at a redefinition of trade, currency dynamics, and supply chain governance. And American investors knew what happened in Singapore would ripple through the stock market, portfolios, and futures contracts within hours. The summit began with symbolic gravity. Leaders from over 50 nations walked onto the stage not with unity but with competing visions. The U.S. pushed for a new trade coalition that favored democratic and free market economies. China, flanked by Russia and Iran, advocated for a multipolar world order, one where no single currency or nation would dominate trade. In a dramatic twist, India, long seen as a swing player, announced it would join the U.S.-led Trusted Trade Alliance aimed at promoting transparent manufacturing standards, digital currency compatibility, and supply chain resilience. That moment sent the Indian stock market into a frenzy, with global investors pouring money into Indian infrastructure, logistics, and defense sectors. U.S. companies with exposure to India saw their valuations explode. Apple, Boeing, and Cisco gained billions in market cap in just 2 days. Back in America, retail and institutional investors alike were digesting what it all meant. And for the first time in decades, investing started to feel like activism. To invest in domestic energy was to support American energy independence. To buy shares in AI-driven freight companies was to bet on post-China logistics. To pull capital out of Chinese conglomerates was not just a financial decision, it was a philosophical one. One investor who embodied this shift was Tyler Ramirez, a 29-year-old ex-Marine turned investment advisor based in San Diego. Tyler ran a small fund called Iron Freedom Capital, which only invested in U.S. firms that met his 3 criteria. No dependence on adversarial regimes. Active investment in domestic workforce development. Technological innovation with national relevance. In just 18 months, his fund outperformed the S&P 500 by 22%. CNBC featured him in a primetime special titled The Patriot Portfolio. Overnight, Tyler became a voice for a new class of investors, those who blended finance with values, security, and vision. Meanwhile, Washington kept pace. The Securities and Exchange Commission rolled out a new geo-risk index mandatory for all public companies, requiring them to disclose the percentage of revenue and supply chain reliance tied to sanctioned or unstable regions. Markets initially reacted with panic. Several multinational firms saw sell-offs when they revealed heavy reliance on Chinese rare earth metals or Russian logistics providers. But over time, transparency bred resilience. The next generation of ETFs began launching with names like Resilient Manufacturing Fund, Strategic Energy ETF, and Free Markets Tech Index. They performed strongly not just because of ideology, but because of sound fundamentals shaped by geopolitical foresight. As for currency, the summit ended with a surprising twist. The U.S. proposed a digital dollar framework to serve as the standard for global trade among the trusted trade alliance countries. Though controversial, the proposal gained traction. With support from Japan, the UK, Canada, and India, markets began pricing in a future where digital central bank currencies, CBDCs, would become the new SWIFT system, faster, traceable, and secure. Crypto markets had a mixed response. Bitcoin soared as a neutral alternative to central control. Ethereum-based tokens tied to logistics and trade compliance gained momentum. But many privacy coins dropped in value as transparency became the new currency of trust. Through all this, one truth crystallized in the minds of American investors. The world had changed, and there was no going back. The investor of 2020 who cared about dividends, growth, and balance sheets was now the investor of 2025 who also studied political alliances, digital currency policy, and semiconductor manufacturing capacity. It wasn't just about being financially literate anymore. It was about being globally literate. And those who adapted didn't just survive, they thrived. As 2025 drew to a close, a quote began circulating widely among finance circles, often misattributed to Sun Tzu or Warren Buffett, but likely coined by a Substack analyst named Ryan Jacobson. In a world at war over trade, the greatest weapon is an informed investor. The next generation of ETFs began launching with names like Resilient Manufacturing Fund, Strategic Energy ETF, and Free Markets Tech Index. They performed strongly not just because of ideology, but because of sound fundamentals shaped by geopolitical foresight. As for currency, the summit ended with a surprising twist. The U.S. proposed a digital dollar framework to serve as the standard for global trade among the trusted trade alliance countries. Though controversial, the proposal gained traction. With support from Japan, the UK, Canada, and India, markets began pricing in a future where digital central bank currencies, CBDCs, would become the new SWIFT system, faster, traceable, and secure. Crypto markets had a mixed response. Bitcoin soared as a neutral alternative to central control. Ethereum-based tokens tied to logistics and trade compliance gained momentum. But many privacy coins dropped in value as transparency became the new currency of trust. Through all this, one truth crystallized in the minds of American investors. The world had changed, and there was no going back. The investor of 2020 who cared about dividends, growth, and balance sheets was now the investor of 2025 who also studied political alliances, digital currency policy, and semiconductor manufacturing capacity. It wasn't just about being financially literate anymore. It was about being globally literate. And those who adapted didn't just survive, they thrived. As 2025 drew to a close, a quote began circulating widely among finance circles, often misattributed to Sun Tzu or Warren Buffett, but likely coined by a Substack analyst named Ryan Jacobson. In a world at war over trade, the greatest weapon is an informed investor.